They charge.
There's no rider charge.
No?
No, there's no
You mean,
rider charge.
you mean the living benefit rider?
Yeah,
No?
living benefit has a no rider charge, remember?
Oh, okay.
Now, let's talk about IUL and fixed index annuity crediting. So today I'm going to talk about how index UL, or for that matter, fixed index annuity, is calculating the interest. As we talked about for last couple of weeks, a lot of times insurance companies determine the interest rate. They invest on their own and they determine, hey, this year we're going to give you 3%. This year we're going to give you 4%. If it's a traditional UL, let's say the minimum interest rate is 3%, some companies are 2%, like Columbus Life is 3%, right? They give you 3% and they come back and say, hey, we can do a little better. This year we're going to give you 4%. They claim the interest rate, right? They announce the interest rate every now and then. What about index universal life and fixed index annuity? How are they calculating, and what's the mechanism behind getting higher rate of return than traditional UL or traditional fixed annuity? Very first thing that you have to understand, these are the portfolio, the financial product. Now, CDs and savings are backed by FDIC. A lot of people know that. What about whole life, universal life, index universal life, and all this? Who's guaranteeing their minimum interest rate? Who's guaranteeing their death benefit? It's the life insurance company. So that's where people get a little uncomfortable. Okay, bank has FDIC. What about insurance company? Who's guaranteeing my coverage? It is insurance company itself. Then you'll say, oh, how do we know that insurance company is solid? Then I go back and ask you this question. How many banks do you know that file bankruptcy? So many. Washington Mutual, Home Saving, Crocker Bank, Indy Bank, they all file bankruptcy. And where are they now? They're gone. Now, how many insurance companies do you know that file bankruptcy? I don't know about you, but I cannot think of any. That's how strong insurance companies' financials are. That's because, as I told you last week, because insurance commissioner kind of dictates where they can or they cannot invest their money. And a lot of times what insurance commissioners are also doing is that they require certain statutory cash reserve. So insurance company has to have some money available for rainy day in cash equivalent accounts. So that's why the insurance company has a very strong financial. And not only that, I don't know why they don't talk about it here, but insurance company is also backed by what? In state of California, there's something called guaranteed association, right? Guaranteed association. It is actually supervised by who? Department of Insurance, just like FDIC. They have a guarantee association, and all different state has a different nomenclature for that, but they also have that. So what about variable universal life? I mean, variable universal life has a partial guarantees. The guarantees with the variable universal life is their cost, their death benefit is guaranteed. What about investment performance? The investment performance of a variable universal life is not guaranteed. Who's doing that? It's a professional money manager. A lot of times they are mutual fund managers. So it goes up, it goes down. So who take the risk on the investment side of variable universal life or variable annuity? Client himself. But you get to have a potential growth potential. But you do also need to assume the investment risk. What about when you put your money in a mutual fund or individual stocks or bond? What kind of guarantee do you have? There's no guarantee, right? So that's the type of a product that you have. Where should you put your money? I'm going to say all of it. Put your money in every different direction. I mean, if you want a little bit of money, if you want to put money in a high growth potential and willing to take a risk, put some money in a mutual fund, put some money in a stock, invest some money. And if you want some solid money and you know that you're going to need the money right away in short-term investment goes to bank. But if you want somewhere in the middle, whole life, universal life, index universal life. All right, that's how this is going. This is the seesaw between risk and return. Higher the risk, higher the growth potential, return. But it also means you're going to have a potential of losing money also, right? Lower the risk, lower the return. So that's the game that we're playing. So there are some people who are saying, hey, but I don't want to risk my money. But do you know that by not risking your money, you're also getting into another risk? It's called inflation risk. People think about investment risk, but they don't think about inflation risk. What's inflation risk? This is from 2020 to 2019. Okay, this is provided by FDIC.gov. And the blue bar represents inflation. Green bar represents 5-year CD rate. 5-year, not 1 year, not 6 months, 5-year CD rate. So that rates are a little higher than other savings accounts. But look at 2010. Which one has a higher number? Inflation. So if you put your money in the bank, in the 5-year CD, then you actually lost money because the price of good went up. 2011, it is about twice as much, right? So 2011, inflation is much higher. You lost even more money. 2012, once again, inflation is higher than your rate of return. 2013, same way. 2014, same way. 2015 is the only year that CD rate outperformed inflation. 2016, inflation wins. 2017, inflation wins. 2018, inflation wins. 2019, inflation wins. So if you put your money in the bank, are you safe?
No.
You're not safe because you're exposing yourself to inflation risk. So what do we do? How do you mitigate between inflation risk and investment risk? The best way is index option. So how does IUL works? Or fixed annuity the same way. So it talks about, very first one they talk about is the investment risk. In 2002, S&P went down 23.37%. 2008, it went down 38.29%. So what it means is that let's say you have a $1 million in your 401k and you're ready to retire. After 2008, your $1 million is now what? $620,000. Are you ready to retire? You may have to work a little longer. 401k is no longer 401k, it's a 201k, right? What if you put the money in the index account? How much interest are you going to get? 0, which means you're not losing anything. You're not gaining anything, but you're not losing anything either. 0 is a hero. What does 0% also means? 0% also means you're not losing your gain up until that point. If it is a 38%, year before, let's say you have a 10% gain. What happened to that 10% gain? It's gone. It's wiped out. because you got big loss. What if you had a 10% gain on index and next year their stock market crash and you get zero? What happened to that 10% gain you had the previous year? It stays within the company. Zero is a hero. Not only zero protect your principal, zero also protect your previous gain. That's the beauty of index investment. Okay. Then how does the insurance company do this? How can they guarantee 0% or 1% for that matter? Sometimes they have a guaranteed minimum interest rate of 1%. How do they guarantee that 0%? Here's how they do it. When the premium goes in, about 96 to 99% of premium that comes in, insurance company put that in their own general account. What does that mean? That money is managed by who? Insurance company. Insurance company is investing. Insurance company normally invest in high quality fixed income portfolio, which means good bonds and good real estate investment. And if they put money in a bad bond, junk bond, what is insurance commissioner going to say? Hey, you got too much money in the junk bond. Change the percentage. Move the money out. Or put more money in cash reserve. So it is a very stable investment. So with that money, what insurance company will do is that they done this night in, night out, right? So they know what to do. They'll keep the money to the original level, 100%. So here's the example. Let's say $1,000 come in, $950. This is hypothetical. $950 goes to the general account of insurance company, and insurance company manages it and bring it back to $1,000 a year later. So even if this $50 does bad investing, what are you still left with? $1,000. That's how they give you 0%. What are they doing with this 5% or $50? They put this money in. They're hedging this money. What does that mean by hedging? They're a lot of times what investment professionals are doing with hedging is that they buy option. What is an option? I mean, that involves full training, but what option is that you have an option to buy? A lot of time we're dealing with option to buy. Let's say one stock price $100 now, and you don't know whether it's going to go up or not. And you purchase an option. Instead of paying money, you purchase an option to buy at $100. 1 year passed by, and that stock went up to $110. And you have an option to purchase at how much? $100. So you purchase at $100 and you turn around and sell that stocks, then you get instant 10%. What if that $100 stock went down to $90? What are you going to do? You discard your option to purchase. So you just lose $50. But you're not going to have big loss in an investment. That's what we call options. So that's what they're doing. So that's why you can only see what's going to happen in a year later. You're not going to be able to see what your options are doing in the middle of the way. Okay? So how does the insurance company give you interest rate on this? They play this option, and here's the next few slides will explain how they calculate interest rate. Very first thing that you have to understand is annual point to point. So if you purchase option here and your option matures a year later, a lot of times 1 year, sometimes it could be 2 years, it could be 3 years. We've seen as long as 7 years too, right? Accumulated 7 is 7 years. So whatever is happening in the between this beginning and end point doesn't mean anything. You start at beginning point and you look at the end point. Let's say your beginning value was $1,000 a share, and end value is $1,100, $1,100 a share. That means you had a up of 10%. What if end point is 900? You have down by 100%, 10%. But this is annual point to point, so you don't have to worry about what's coming in between. Okay, that's what we call annual point to point, and it could be biannual, it could be triannual. I mean, I seen 5-year thing. I seen 7 years. It could be as long as they can make it, but most of the time it's annual point to point. Very first thing they do is they play participation. In this particular example, there's 110% participation. So if stock does 26%, the index does 26%, how insurance company will do is they multiply that by 110%, which is 28.6%. So that particular year, the index will give you, the index cash value will give you 28.6% rate of return. But sometimes it is lower than 100. Sometimes, let's say many times it is a 50%, 70%, right? If it is a 50% participation, what's 50% of 26%? 13%. So you get 13%. So whatever index is doing, you multiply that by percentage of your participation. Okay? Now the next one is 80% increase. You multiply that by 110%, which is 88%. Like I said, if it is a 50% participation, you get 40%. What if it went down negative 20%? If it went down negative 20%, sometimes people are saying, okay, that means I'm going to have to get negative 10%. That's not how it works. There is a minimum interest rate of what? 0%. So you're not going to get negative 10 or negative, what is it? In this case, negative 22. It's 110% participation. So you get 0. That's a participation. Okay. Next way to calculate is cap. They give you cap. Let's say cap is at 8%. And there's 150% participation. Stock went up 3%. You get 3 times 150%, which is a 4.5, which is lower than 8%. So your interest rate is 4.5% that you're getting. Let's say it went up 20%. What is a cap? 8%. So 8% cap means you get 8%. What if it went down negative 20%? You get 0%. The next one is spread. Some company gives you spread. Let's say there is a 2% spread. If index does 10% after the end of segment, if it's a 2% spread, you get 2% less, which is 8%. If return the index did 3% after the segment, 3 minus 2 is 1%. So you get 1%. What if we went down to negative 5%? Negative 5 minus 2 is what? Negative 7. Is that negative 7 you're getting? No, you're getting 0. You get 0%. Okay, what if you get 1%? 1 minus 2% spread is negative 1. Do you get negative 1%? No. The minimum you're going to get is, once again, 0. So you're not losing your principal. You're not losing gain you had until that point. Okay? That's with the spread. Another option they have is something called monthly sum. What is a monthly sum? This one is a monthly sum and 1% cap. So instead of doing annual point to point, they do every month. they check the index every month for next 12 months. The final calculation, final interest calculation is not going to be done until the last 12 months, the last month. But until then, they check every month index. So first month, it went up 3%. So since there's a cap of 1%, you write 1%. Next month, 0.97%, which is less than 1%. So you put on 0.97. Month 3, 0.96. So you put on 0.96. Month 4 is a negative 0.95. So you put on negative 0.95. Wait, did I not say that 0% is a minimum? But not during this calculation. Once again, we're not done with the calculation. But you write down the minus also. Month 5, it went up 2.88%, but since it's more than cap, you get 1%. Month 6, 0.93%, so you get 0.93, which is less than 1% cap. Month 7, you got minus 0.93, so you put down minus 0.93. You get the grips, all right? Eighth month, 1.87, so you get 1. Ninth month, minus 0.92, so you get minus 0.92. 10th month, 0.93. 11th, minus 0.92. 12, minus 0.93. So you got all this percentage for 12 months. So what you do is you add them up. It's a monthly sum. So you add them up. And when you add it, the number came out to be 2.14%. If it is a 2.14%, is it higher than 0? It is. So what is the client's going to get? 2.14%. Okay. I just realized I forgot something. There's something called monthly averaging that Columbus Life is doing. Monthly averaging, what you do is you add all this, 3.97, 0.96, minus 0.95, 2.88, 0.93, minus 0.93, 1.87, minus 0.92, 0.93, minus 0.92, minus 0.93. You add them all up and divide it by 12. That's a monthly average. And you add that, you compare the monthly average from the beginning index and you calculate the difference, and the difference is positive return, you get the positive return. If difference is a negative return, you get what? 0. Okay, these are the common index options. And these are the actual numbers. This is from National Life. From 2002 to 2021, this is a Credit Suisse actual index. Now, this is what they're charging. This is 130% participation. So you get 130% of their return, and minimum is 0. So when index is doing 12.39, you get 16.19 at 16.1. When it does 7.14, you get 9.29. When it does negative 0.43, you get, since it's a negative number, you get 0. When it does a negative 2.21, you get 0. So what you do is you get all this. This is almost last 20 years. And 5-year average, last 5-year average was 6.9% per year. Last 10-year annual average is 7.51%. Last 15 is 6.63. The illustration you run is running at 5.64. So it is actually outperforming the illustration. Now these are the S&P index changes, actual numbers, right? When is a negative 23%, you get 0. So very first one, we have S&P 500 point to point, cap focus, cap is at 8.75, participation is at 100%. Now you see what that means, right? So when it's a negative, you get 0. 26.38, this is higher than 8.75, so you end up with 8.75. 3.53, which is lower than 8.75 and it's still positive, you get 3.53. You go on and on and on. So last 5 years, average rate of return per year was a 6.94. Last 10 year was 6.94. Last 15 is 6%. Last 20 year was a 5.94. Once again, the illustration was ran at 5.64%. It outperformed, the historical performance outperformed the illustration. And next one is S&P 500 point-to-point participation focus. Cap is at 6.5. Participation is 140%. You know what to do. And the one after that is S&P point-to-point 1% floor. This is a minimum 1%, not 0%, 1%. But cap is at lower, which is cap is 6.75. Participation is 100%. Whenever you see the negative number, you get 1. Right? So here are the average rate of return: 5.57 for 5, 5.57 for 10, 4.97 for 15, 4.93 for 20 years. And that's with National Life. The next one is Columbus Life. Columbus Life, you got all these numbers, and they have cap rate of 8.5%. Anything above 8.5, you get 8.5. Anything below 8.5, and you get and it's above 10%, you get the full interest rate. Okay. And this is Enicos Index Annuities. They get 1% bonus. I'm looking at 10 years. Fixed is a 3.5. Monthly sum 2.4% cap. Monthly cap. 1 year point to point is 6.5% cap with 100% participation. 50% participation is a 6.7%. On uncap, there's a S&P 100 uncap, but participation rate is 30%. So whatever S&P 500 is doing, which is positive number, you get 30% of the gain. NASDAQ 100 is 100% participation with a 6.5% cap on it. Mark 5%, S&P 5, Mark 5% that I love is 115% participation with no cap. Okay. All right, that kind of ends my training on index annuity. Any question?